Hello and welcome to the market update for Monday, December the 28th. Just a reminder that this week we're doing the classes on Monday and Wednesday again, and then next week we'll go back to the regular Tuesday, Thursday format. So we had to do it that way for the holidays with Christmas Eve and New Year's Eve falling on a Thursday. So we'll revert back to the regular schedule next week. And hopefully everyone had a great holiday over the weekend, and looking forward to another one this upcoming weekend. This is going to be a short trading week again, with the market being closed on Friday for New Year's. There should be, last Thursday we had a half-day trading for Christmas Eve. That won't be the case this week. The New Year's Eve, I believe, is a full trading day. I'll have to double check that, but I usually don't trade this time of the year. This is usually when I take time off because the market, you have a couple days where the markets are closed. Volumes are usually really low, and if you're going to have time off during the year, for a trader, it's usually the only time to really get a full week or a couple weeks off. So. So just be aware of that schedule this week. It's really important if you trade options, because if you're used to options expiring on Fridays, especially the weekly options, and they'll be expiring on Thursday this week, as they did last week with the holidays. So it becomes important. All right, now we'll get started with the market update here. The training today, after I do the market update, is going to be on the VIX, talking about the VIX and what the VIX is. You hear me talk about a lot in these market updates, and I'm going to explain a little bit of how the VIX works, why we even look at the VIX, and how it can be helpful in your trading. And so those that want to stick around for that afterwards can do so. Those that want to catch it on the recording later can also do so. Now, as far as the market conditions, we are hold on here. We are in a historically bullish time of the year, especially the week between Christmas and New Year's tends to be very bullish. Doesn't mean the market always goes up, but there's a tendency for it to usually move higher, and we're seeing that today, up pretty strong today. S&P's up almost 1%. As far as the direction alerts go, one thing that concerns me a little bit is that we're seeing momentum start to slip a little bit. It's not keeping up with the other indicators there. It doesn't surprise me, because when you look at the market performance over the last couple of weeks, it's been more sideways. Although we've had up days, we've had some down days, but even on the up days, we've just kind of gone back and forth. We really haven't taken off again or been in kind of an impulsive move. And so that's showing up the momentum indicator there, as it's been kind of lagging a little bit. Breadth has been performing, and it's getting into that extreme range. Now it can get even more extreme, and the fact that the momentum is not in the extreme range or close to that, and the sentiment's not in the extreme range, we're not dealing with a market. They're definitely not dealing with a market that's overbought or gone up too far too fast or anything like that. Sentiment is backed off into the complacency range. It's still in the high range, but it's not in the extreme range there. If we look at the buy-sell ratios, I talked about this last week, how they'd come closer together, and I said now what could happen is that they've kind of alleviated that overbought condition, and we might see, if the market does start to trend again, start to move higher again, they could start to widen out again, and we might be seeing that today, and maybe this week. If this is indeed a bullish week, we see the market continue to move higher, we might see those widen out. But definitely, we're not in a danger area where we're getting signals of a impending pullback or anything like that. Sentiment, the sentiment chart here is off the highs. It's not in that extreme level there, and so we're not getting any warning signs that there's any sort of impending sell-off. Now, Doesn't mean that can't happen. And sometimes you hear me talk about getting the feel that the market is getting ready to pull back. And I'll sometimes say, I hope that we get some warning signs. I hope we see some indicators that are warning us that a sell-off is maybe likely to happen. That way you can prepare for it. You can start to, lighten up your positions, tighten your stops, take profits on trades, so that you don't get hammered when the sell-off comes. But we don't always get warning signals, and so in a condition like this, your warning signal might just be that the market is it's stagnant. It's not really going. There aren't a lot of high buying activity to drive prices higher, and this is a condition right here where sometimes you can see a sell-off come out of nowhere, and it's almost like the market is sleeping a little bit, and then it needs something to kind of jolt it or wake it up. And sometimes a sharp sell-off can not only wake people up or wake traders up, but it can also bring in people that have been waiting for a dip. Maybe people aren't buying right now because the prices are too high and they're waiting for a deal. They're waiting for prices to come lower to where they feel more comfortable getting in. So you get a market sell-off, a sharp one that wakes everyone up, and it wakes those buyers up. They come in, and sometimes the market can drop a day or two and then come roaring right back and take off. So that can happen in these types of conditions. So what I would prefer is that it starts to heat up again from here and at some point starts flashing some of those overbought conditions. Maybe the sentiment indicator starts getting into the red, and then you not only do you get to trade that move higher and make money on that move higher, but you start to get those warning signs that maybe it's getting a little overdone, and then you can kind of get out and not be sitting there when the not be looking for a chair when the music stops. And so hopefully that's kind of how this ends up playing out for us. All right, let's move on to our charts. So you can see this is exactly what I was talking about. This is a chart of the S&P 500. It's just been moving sideways for the last couple of weeks. So when it looks like we're starting to take off, we kind of lose that momentum and come back down. Today is looking very similar to a move that we had about a week and a half ago right here, where we moved to the upper part of this range. We barely broke out to a new all-time high, and then we immediately kind of sold off a little bit. We're not quite at a new all-time high. We're very close to another new all-time high. And that could, we still have an hour or 2 hours before the market closes, so that could end up hitting a new all-time high there. But then we want to see, does it build on that? Does it continue to break out, move higher, or does it stay in that range? We got to kind of really break out this range to really feel comfortable that the trend is going to start taking off again, and the uptrend is going to start taking off again. But this kind of shows you what I was talking about earlier, where it gets stagnant a little bit. You get that drop, and then it tracks the buyers. Here it was a day where it dropped, and then it gapped lower at the open, and immediately those buyers came in, and we're pushing things back up again. It happened back here too. Had a little bit of a sell-off right there. Moved back up right here. It might take something steeper, something more like this, where it dropped down a lot further, but hopefully that doesn't happen right here. It doesn't look like that's going to happen. I'm not seeing warning signs of that just yet. All right. The DIA, same thing. You're going to see the same, although this is at a new all-time high. If this can hold, it's kind of backed off the high of the day, but if it can hold right here, it'll be at a new all-time high. But still, it's been kind of moving sideways. And then, like, if you look at today, it was up higher and it's kind of faded a little bit. It's not a real strong sign that the buyers are really performing strongly there. In fact, that's kind of a little For those who've been through the candlestick training, that's a little bit of a weaker signal, loss of momentum there from the trading day. So although we're up and up a decent amount, we've lost a lot of momentum from the highs of the day, and that concerns me a little bit. The QQQ, the same thing. Now the Russell's been the one that's really outperformed, and so what concerns me a little bit today is the fact that it is trading much lower from where it opened. It opened strong, trading much lower, and it's pretty close to going negative compared to the close last week. So that concerns me a little bit because of the fact that it hasn't been moving sideways. It's been trending up. So if we're starting to see the Russell 2000 sell off, then it could be a leading indicator that we're getting maybe starting a correction of some sort, or pullback of some sort. So we'll keep an eye on that. Bonds, TLT still trending lower. It's trying to rally a little bit though. On some of these days, here we opened lower, we closed higher than the open. Today we opened lower, we're gapped lower. We could close higher than where we opened, but we're still kind of sliding downward. We're still in this downtrend right here, and so until that breaks, we're going to assume that bonds are continuing to trend down. That's what they're showing us so far. If we move over to gold. Gold had been trending up. We were starting to see higher highs, higher lows here, at least in the near term. This was the last lower high, a major lower high right here from so it had the lower high right here, and then we went to a lower low down here. Now in the near term, we're getting shorter term higher highs, higher lows, but we really need to break above this area here to really reverse that downtrend that it's been in. So we're real close to really turning a lot more bullish on gold. But this behavior in the near term is encouraging that gold is starting to trend upward. We just need, you don't need to have additional confirmation. It's whatever confirmation you want. If this is enough confirmation for an uptrend in gold, then you can go ahead and buy in there. But there have been a few of these false little breakouts that have happened. This was one where it broke out higher and then just reversed right back down again. And just the choppiness of this move, I'd want to wait for a little bit more confirmation that gold might be turning the corner a little bit. Oil had a little bit of a pullback right in here. It's been trending up pretty strongly, and now it seems like it's rebounding again. It's still, that uptrend still looks intact. So again, I'm assuming that oil is going to continue to move higher based on what I see right now. The dollar is continuing to trend lower. Lower highs, lower lows. So on the dollar right here, you're going to be looking at this high right here. If we can break out above that, that would reverse that pattern. And if it rallies from here and breaks out, you'd also have that higher low at that point. And then you could be breaking out to a higher high. So until it does that, though, we're assuming that downtrend in the dollar is going to continue until we see it break that trend. And finally, the VIX. The VIX is continuing to move lower. We're going to talk about the VIX today in our training, but it's signaling that the professional traders aren't too concerned about the market selling off. At least they're not showing it yet. There is a little bit of a bullish reversal candle today where it opened lower and it's up a little bit from where it opened. In the short term, that could possibly mean that maybe it starts moving up a little bit, and so we'll keep an eye on that and see how that ends up closing. That could change between now and the end of the day, but we'll keep an eye on that and see if that changes at all. But the trend, though, is still lower, and not really seeing a lot of concern yet of a market sell-off, at least from the professional traders. And like I said, I'll train you on this today so you can learn a little bit more about how to read the VIX and and why I even look at the VIX. How can it help us as a trader? All right. As far as individual stocks, let's go into our sectors here. And under computer technology, I'm going to go into the hold section here and look at this is a 97 strength rank, but SITM Corporation, Sitime or Sitime Corporation. I don't even know how to pronounce that. Anyway, let's switch over to the signals here. Now this was just at a buy signal, just barely dipped to a hold. But again, the trend is real nice right here, and it could pull back a little bit further, but it could just rebound and start going right back up again. So it has a nice, strong uptrend. And so if this thing can go right back to a buy signal, I like that trend there. And again, nice strength rank at a 98, 97 strength rank there. And then I'm going to dip all the way down. There weren't a lot of individual stocks that I liked. I went through a lot of these sectors, so that could be a little bit of a warning sign. Now, remember, we're looking under the hold section here, so it could mean that a lot of these stocks have buys, and maybe they've had buys for a little while. But that could also be an indication that maybe the market is in a position where it can start to pull back a little bit and start to. Although I don't see an overbought condition. So if we were in kind of an extreme overbought condition and we weren't seeing a lot of trades that were in the hold section, that would concern me a little bit. But now one thing that I think is important to point out here, though, is if you do go through your sectors and you're not finding a lot of good patterns to trade, or maybe you're only able to find one or two, that sometimes can be a signal to just sit out and wait. The best times to trade are when there are so many trading opportunities. You're the toughest part of your job is trying to pick out from all the great trading opportunities that are out there. That means you're in a very strong bullish market condition, and that's when you want to be trading a lot. You want to be trading as much as you can in those conditions, because it really means that everything's participating, everything's going, everything's moving, and your chances of making money are so much greater because of that. When I have to go through watch lists, and I'm looking at, on a typical day, I'm looking at 300 to 500 stocks at a minimum when I go through my list, and I can do it very quickly. So it doesn't, I can do that in about, 20 minutes. So it's not like it's time consuming. But if I'm going through that many stocks and I'm only finding one or two patterns that I really like, that really jump out and say, boy, this looks really good, that's telling me right there that that doesn't mean I can't make a trade, but it definitely tells me that the conditions aren't the greatest. And I've already pointed out, as we've gone through this update, we haven't seen anything that's screaming market pullback, but I haven't seen a lot that's been pointing to the market really charging forward either. And so we're in just kind of a stagnant period right here. And when I combine that with the fact that I'm not seeing a lot in these scans that I really like, that can be an indication to just, take the week off, or take a few days off, and combine that with the holiday season. It's a good combination there, just to take a couple of days off, get away from the market, and recharge the battery a little bit. But I did find a couple under the medical sector. So for those that are looking for a stock today, there are a couple that look okay. But I had to get all the way down to the medical sector. I was kind of working my way down until I found some patterns that I liked, aside from that one in the computer and technology sector. But in the medical sector here, if we go down to our 98 strength rank, this ALT, Altimmune. Now this one's come way down, and it may not look like a great pattern here, but if you look long term, you can see what I was looking at, especially if you attended the chart patterns class from last Wednesday. this, we had this big run up right here. We come down, and then it looks like we have a little bit of an inverse head and shoulders formation here. And remember, this is one of those bullish formations that I said was, I love these patterns. Now on a stock like this that has been kind of beaten down as much as it has, you could wait for that additional confirmation, wait for it to break that neckline, get up here around $15 or so, clearly break that neckline there, because the potential is it could run back up to this area here. Maybe not right away, but it could start trending towards that previous high. Now, it doesn't mean that this is going to hold as an inverse head and shoulders pattern. Could it drop and end up not being a head and shoulders pattern or inverse head and shoulders pattern? Absolutely. But so far, it's looking like it's holding up pretty well. And so you could either wait for it to go back to the buy signal as confirmation, although it's done that a couple times through here, or you could wait for it to break that neckline there, and that would be a much stronger buy point. And like I said, with the conditions that the market's been in lately, I might wait for that additional confirmation. But I like that as a longer term pattern that's developing. And you could make the argument, well, Jerry, this thing hasn't really gone anywhere for the last several months. It's just been moving sideways. Yeah, that's why I'm saying this is more of a longer term type of a trade, because you're not expecting it. It may be a few more days or weeks before it really starts taking off, or it breaks that neckline there. But if it can do it, the long-term potential of this over the next few months is pretty good. Another one that I liked under that medical sector was this RVP, Retractable Technologies. And this one has already been in a nice uptrend, higher highs, higher lows. There's our higher highs, here's your higher lows. It hasn't fully established that higher low yet, but if it does start to move back up from here and goes back to that buy signal, it will give you a higher low, and that pattern, that uptrend behavior will continue. If you were to draw a trend line up through here, you're right along that trend line. Like I said, it could pull back a little bit to that trend line a little bit more, but you're real close to holding that trend line. If it can start to move back up, go back to that buy signal, I think that'd be a good entry. All right, so that's the market update for today. Let's get into the training. Now, I probably should have done the training on this after I do the classes on options, because you kind of need to understand how options work a little bit to understand this a little bit better. But to be honest, you don't even need to understand options. If you can understand the explanation I give you of what the VIX is showing you, you can use it as a tool without even really fully understanding how options work. But we will have trainings on options for those that want to learn how to trade options, get into that. We'll do some trainings on those in the future. But so to give you a little bit of a background of the VIX, and I know this is a VXY. Let me briefly, let me pull it up here first. On TradersPro, we pull up the ticker symbol VXY. The reason for that is that the VIX indicator it's not a tradable instrument. Okay, it's like the NASDAQ Composite Index. You can look at charts of the NASDAQ Composite Index, but you can't trade the NASDAQ Composite Index. You can trade the NASDAQ 100. There's an ETF for the NASDAQ 100, the QQQ. We look at the QQQ all the time, but you'll notice that if you compare the NASDAQ Composite Index to the QQQ, they don't always trade exactly the same way. Well, that's the same with the VIX and the VXY. The the VIXY is the trading instrument for the VIX. It's a way to trade the VIX. Okay. Now, we're not going to be trading the VIX. I do not recommend trading the VIX. It's a very complex indicator, and the way it trades is so unlike regular stocks that it can be very confusing because it doesn't always move the way you would expect it to move, and it can be very frustrating. So I'm not recommending that you trade the VIX, but that's why there's a difference here. Whenever I say VIX and you say, well, this is VIXY, this is the ETF or exchange traded fund that allows you to trade the VIX. Now, a little bit of background. The VIX, it's referred to as the Volatility Index. It was developed by the Chicago Board Option Exchange back in 1993. And the definition of the VIX, and this is why I could lose people very quickly, is you probably won't understand the definition, but don't be worried. I'm going to simplify it. One thing I've always tried to do in my coaching career is to try to take complex things in the markets and try to simplify them to where the average person can at least basically understand what it's doing. But the VIX uses short-term, near-the-money call and put options to measure the implied volatility of the S&P 500 index options over the next 30 days. And I probably lost everyone with that definition. So I'm going to simplify it, and I promise you, if you can stay with me in today's class, we're going to take this very complex instrument and make it a lot easier to understand. My definition of the VIX is that it measures the level of freaking out of the big institutional investors. Now, who are the big institutional investors? They're the big money players. They're the ones that are buying millions of shares of stock. They're the one and selling millions of shares of stock. They are the ones that are moving the market, right? When you and I go buy 100 shares of IBM, we're not moving IBM anywhere. When a big fund manager goes out and buys 1 million shares of IBM, he is going to move the price of IBM. IBM is going to start moving up as he's buying those million shares. Okay. Now, why do we have to be, what does this matter? Well, I think that's the beginning stage that we have to understand our place in the market. Okay. I'm fairly confident that I'm not talking to huge fund managers in this class today, because you wouldn't need me to be talking to you. You'd already understand all this stuff. And so I'm assuming that we are the retail traders. We are the smaller traders. Okay. We need to understand that. We need to understand that our job is not to try to outguess the market or try to be smarter than the market, especially in this format that we're trend followers. And I'm assuming we're trend followers because you're using a trend following service in TradersPro. So that's kind of what we're about. We're not trying to move the market. We're trying to follow those that are moving the market. And that's important to understand, that these big institutional investors, they are buying millions of shares of stock and selling millions of shares of stock, and they're moving the price of these stocks up and down. Now, the fact that they're buying those million shares, you have to understand that they can't go in, and if they want to buy 10 million shares of IBM, they can't go do it all in one order. See, you and I, if we want to buy 100 shares of IBM, we just place the order, we get in, the price doesn't move at all, we get all 100 shares filled at $100 or whatever the price of IBM is right now. Okay. If they want to buy their 5 million shares of IBM, they can't go in and place an order to buy 5 million shares at $100. Why? Because there's not enough shares available to buy at $100. What will happen is they'll buy it. There'll be a few thousand shares they'll get at $100. Then the price is going to go up to 100. I don't know, $102 or something like that. They're going to get filled on a few other 1,000 shares, 102. Then it's going to go up to 105. And yeah, they're going to get filled on their order, but they're driving the price up as they're trying to get in. So they're jacking the price up on themselves by trying to buy too much too fast. So what they have to do is they have to ease their way in. They buy a few thousand shares at a time, wait for the price to fall back a little bit, buy a few more thousand shares, wait for the price to pull back a little bit. Now, this should look familiar to you because a few weeks ago we talked about how to read charts. And what is this forming? It's forming that stair step. That's what creates that stair step up and the stair step down, is that these big institutional investors, they buy, wait for it to kind of pull back a little bit, and then buy some more. And so, yeah, the price is going up. And yeah, they're causing the price to go up because they're trying to buy that large amount of shares, but it's not going up so fast that they can't handle it. Now, ideally, they'd like to be able to get in without moving the price, but it just depends on how aggressive they want to buy it. I mean, if all their indicators and all their analysis is saying, we really like this stock and we really like it at $100, it's good. I mean, think about human nature. It's going to be hard not to try to buy as aggressively as you can get away with. Now, if they think it's okay at $100, and then, but they're not just, they're not obsessed with getting it at $100. They're not so excited about it at $100. Sometimes they can even buy. They can spread that buying out even further to where you don't see a trending. It's more gradual. It's maybe a little bit more sideways or something like this, where they're really able to accumulate those shares without pushing the price up. But you've got to understand this concept before you understand the VIX, because they can't get in very quickly, which means they can't get out very quickly. What if they bought in? IBM went from $100 all the way up to $150. They've made all this money on their buying of IBM, and then suddenly some really bad news comes out, and some major group of companies out there say they're no longer going to use IBM services or whatever the bad news is. Well, guess what? Again, our advantage is that, oh man, that's bad news. We bought 100 shares at $100. It's now worth $150. We can sell all 100 shares, get out of that thing. Let's say it dropped very quickly to $140. We can get out of our 100 shares. We're out. But guess what? This big institutional investor, he can't get out that fast. If he starts to sell those millions of shares too quickly, that's when you get those big drops. And he's going to lose a ton of money as it comes all the way back down. So how does he protect himself then? Well, what he could do if he expects that stock is going to drop in a big way is he can go out and he can buy put options on the stock. Now, again, you don't need to understand what a put option is, fully understand what a put option is, except for this for now. I mean, I'll teach you this a little bit later when we learn about options. But basically, what a put option allows you to do is when the stock goes down in value, that put option goes up in value. Now, an option is a way to, it's a leverage instrument that allows you for a very small amount of money to control the movement of a larger amount of shares of stock. So to give you just a layman's example here, I could buy, if I think that IBM is going to drop back down to $100, I might be able to buy a put option on it for, let's say, $2. And if IBM went from $150 all the way back down to $100, that put option could go up in value from $2 to about $50 or so. Now, why is that significant? Well, it may not be exactly. It may be more like $45 or something like that. Let's say $45. Actually, no, it would be It'd be at least $50 if I bought the $50. Let's assume I bought the $150 put. Okay, it'd be worth at least $50. So in other words, the stock dropped $50 in value, but my option that I paid $2 for went up to $50 in value. Now, remember, I bought it for $2. Let's say I could sell it for $50. I would make $48, right? So I didn't quite completely avoid the loss. I had a $50 loss in the stock as it dropped back down to $100. But my put option went up $48. So instead of a catastrophic $50 loss, I have a $2 loss overall because I didn't quite get the full 50 back. But I have 48. Okay. Now, in order to do that, though, I had to spend that money. I had to buy that option to do that. I had to spend money to buy that option. Okay. Now you say, well, that's real simple then. Anytime that those big fund managers think they're going to lose money, they just buy that insurance policy. They buy that protective put. It's like an insurance policy, and then if it does have a big drop, they're protected. Now, that sounds real simple. But what if I buy that? What if I buy that $2 put option and the stock doesn't drop? Well, now I need the stock to go to at least $152 to make up for that money I spent to buy that protection, to buy that insurance. Okay. So what I'm trying to introduce you here to is the fact that it's not a simple decision. It's much like the protected puts are a very good analogy for protected puts as insurance policies. Okay, you're not going to spend the money on you don't spend the money on your auto insurance to protect you from some little kid opening his door too fast at the Walmart parking lot and puts a little ding in your door, right? You're not spending hundreds of dollars a month in car insurance for that, right? Because for the amount you spend on your insurance, you could probably go get that little door ding fixed on your own. No, you spend the hundreds of dollars a month in car insurance to protect against somebody running a red light and smashing into your car and totaling it, right? So these big institutional investors, they don't want to buy that protection, that protection, unless they know that they really need it. At least the heavyweight. Sometimes when they think it's getting a little lofty up here, they'll start buying a little bit of protection just in case. And they're not spending a lot on it. They're not trying to protect the entire position, but maybe a part of it. They'll buy a few contracts of protected puts. But when it really starts to drop and you get these really big down moves, then they panic and they're running out there to buy. It's kind of like if you said, "Oh, I don't need flood insurance. I don't need flood insurance. I see no reason to have flood insurance," but suddenly the dam breaks up the road. Now you want flood insurance, and you're willing to pay whatever price. What used to be a $100 policy for flood insurance is now $1,000. You're saying, "I'll pay it." Why? Because that $1,000 is still better than having your whole house wiped out, right? Well, that's another element of this, is that in options, there's a part of the option price that is what's called implied volatility. And again, I'll talk about this when we talk about options later on. But it basically, it can go up or down based on demand. So in other words, when a stock is trending up, when it's moving up, the implied volatility on those put options is very cheap. It's very low. Why? Well, because you're not going down, you're going up. There's no reason for it to be expensive. It's very cheap. And that's why if you ever watch CNBC, a lot of times they'll talk about this. They'll say, hey, the market's made a big run. It's gone up. It's getting a little overbought. It's not a bad idea to buy a little protection here, buy a little of these protected puts because they're cheap right now. However, it's not that simple because, again, you're spending that money to buy those puts. So if I'm a fund manager and if I start loading up on these cheap protective puts and the stock keeps going higher and my performance is not as good because now I bought all these protective puts at $150, I have to, in order to get back to break even again after buying those $2 puts, the stock has to get to $152. So the stock goes up $2 and I didn't make anything because that was just to pay off my protective puts. So imagine if you're a fund manager and you go to your boss and your boss says, oh boy, IBM had a nice move today. It had a nice $2 move today. How do we do? And you say, we didn't make any money today because I bought protected puts. And he says, well, why did you buy protected puts? Well, I thought we might need them. Well, what's he going to say? He's going to say, well, we just had a $2 move of the stock. We didn't make anything. Quit buying protected puts, right? It's human nature not to think we need insurance when things are good, right? But that's when you usually need to buy that protection. So there's a dilemma there these big fund managers are faced with. I can buy it when it's cheap, but I may not need it, and my boss is going to be mad that I'm buying it when it's cheap. Or I can wait, but if I wait, what happens is if the stock starts to drop, what happens is that implied volatility goes way up. That option that might have cost me $2 up here when it was cheap, that same option might be worth now $6. Just in the increase of implied volatility. So like that insurance policy was $100 for the flood insurance. Now the flood is coming. That insurance guy is saying, okay, well now you want it? It's $1,000. And I'll pay it because I need it. I know I need it, but it's going to cost me a lot more. And so there's that balance of where do you buy it? Do you buy it when it's expensive and you have to have it? Or do you buy it when it's cheap when you don't have to? There's a whole range here the very emotional range here, emotional spectrum here. Now, let's go back to what the VIX indicator is doing. The VIX indicator is measuring the difference of that implied volatility, that level of freaking out. This is a high level of freaking out because now the premiums on that insurance are going way up. Now, another thing to understand about the VIX is that it works inversely to the market typically. And this is important because when it doesn't go inversely to the market, we want to pay attention. Meaning that when the market is going up, the VIX is usually trending down, which makes sense. If the market's going up, that level of freaking out by the big institutional investors is dropping. They're not concerned. They don't feel a need to go buy any protection. And they definitely don't see a need to buy expensive protection. And it's not going to be expensive protection. The protection is going to be cheap. When the market starts to drop, the VIX will start to move up. It'll start to spike. And that tells you that those professional traders, and again, this is key throughout this whole process. This is measuring the professional traders. So one thing we're assuming too is that these professional traders, not only can they move the market, but they probably know more about what's going on out there than you and I. Not only because they're in the whole business to know more than you and I, but they have the resources to know more than you and I. They invest millions of dollars in software programs that can analyze these companies better than you and I could ever dream. They've got connections. They got political connections. They've got connections with other companies that to know more about what's going on. They have to know this because of the fact that they've got to be they've got to move slowly. They got to get in slowly and get out slowly. So they got to make sure they have that edge. So just because the big institutional investor is freaking out doesn't mean that the market has to drop or that stock has to drop. Not necessarily, but again, I'm going to assume that they know more about what's going on than I do, and so I'm going to follow with what they're doing. I'm going to assume that they know something I don't. So most of the time, the VIX is really not helping us at all, because if the market is up and the VIX is down, okay, that's what it should be doing. The market is down and the VIX is up, okay, that's what it should be doing. So the real subtle thing that we're looking, there's a few things that we're really looking for, and they don't happen all that often. So, but when they do, we need to pay attention. So I do check the VIX every day, but the VIX doesn't tell me anything significant every day, or doesn't always tell me something significant every day. Now, what could be significant? Well, what if you have a market that's trending up and the VIX is trending down, and then you have a day where the market goes up, but the VIX goes up? Whenever the VIX and the market move in the same direction, pay attention. What would that mean for me? Well, what that would tell me, remember, if the VIX is moving up, that level of freaking out is moving up a little bit. Not in a huge way right now. I mean, there's different degrees of freaking out. But what that would tell me is that the professional traders might not quite trust the rally. They might be looking at this and saying, boy, we've gone up so far, we're getting overbought. Now, I don't see any disaster looming, but I'm really uncomfortable buying more shares right here. So in order for me to feel more comfortable buying more shares, I'm going to buy more shares, and I'm going to buy some protection. I'm going to buy some of those protected puts. And that's causing the VIX to move up. And the reason why the market is moving up is because he is buying those shares, but he's also buying the protection along with it. Now, just because this happens doesn't mean that the market's going to crash, okay? And this is why you never use the VIX by itself to make a decision. But if I'm looking at all the other indicators on TradersPro here, and all of them are extremely overbought, we're in the extreme, you go back to the direction alerts, and all those indicators, the momentum, the breadth, the sentiment, are all in the extreme ranges. The buy-sell ratios are really wide. The chart of the buy-sell ratios is really wide. And I see the market's gone up today and the VIX is moving up, meaning the professional traders are starting to get a little concerned about the rally. That's what they're telling me, is they're concerned. They're not panicking yet, but they're concerned. You line all that up and you're saying, hey, we could be very close to getting a market pullback here. This is not a time I want to be buying and buying aggressively. This is a time when I want to tighten stops. I want to take profits off the table. Now, I'll tell you right now, though, too, this can change in one day, where they were a little concerned. The next day, the market goes up and the VIX comes right back down again. What does that tell me? Okay, they were concerned for that day. Now they're not so concerned. By the way, this could be tied to politics as well. I've seen this happen a lot recently, where Congress is, one day they're close to a deal, next day it's falling apart. And so the market moved up even though it looks like the deal could be falling apart, but then the VIX moved up a little bit too. So those professional traders were saying, hey, if this thing falls apart, that's not good. I better buy some protection. So it can jump back and forth. But even then, if all the other conditions are extreme and you get any sort of a day where the VIX is up and the market is up, that's usually a big warning sign that, because even if the market doesn't drop immediately, it could go up for 3 or 4 more days. But what it's telling me when it does that is that those professional traders are worried. They're not freaking out yet, but they're worried. And if they're worried for whatever reason, I don't even know what the reasons are. I don't need to know if it's based on Congress or based on something else. All I need to know is they're showing me they're worried because they're buying that protection with the market going up. Now, the opposite can happen. What if the market's selling off? It's been selling off. The VIX is going up because it usually moves in the opposite direction. And you get a day where the market has a big down day. It drops. The Dow drops 400 points. And the VIX goes down. What could that be telling me? Well, for me, it would be telling me that the professionals, although it seemed like a pretty bad down day, the professionals aren't too concerned about it. So it might be that we're nearing a bottom. They're not feeling the need to buy more protective puts. In fact, they might be selling their protective puts that they've already bought, and that could cause the VIX to drop down like that. Now, again, you're not going to want to. I'm not going to go run out and buy a bunch, buy shares of the stock, or in this case, buy the market just because that the market was down, the VIX was down. But if you start to see all those other indicators on the software showing extreme oversold, it could mean that we're getting real close to a bottom and where the market could start to rally back up a little bit. And that's what we saw. I can't remember which update it was. It's one of the more recent updates where we had a down day, but the VIX was, and there's different degrees. The VIX could be barely down or flat, or even if you have a big down day and the VIX is up, but it's barely up. So there's different degrees of this. But again, this is the real subtle way that we're looking at this. And if you have a really big down day and the VIX is barely up, that's telling me those professional traders aren't really worried about it. They're not freaking out about it. And now, what if you've been trending up? So sometimes what will happen here is you'll be trending up. Obviously, the VIX is usually trending down, moving down. And then you get what if you get a little bit of a sell-off day? Dow's only down 100 points. But you see a pretty sharp rise in the VIX. It spikes. That usually tells me that maybe we're starting a bigger correction. We're not seeing it yet, but it looks like those big institutional investors are seeing it. And they're getting in, they're buying those protected puts pretty heavy right now because they must think that a bigger drop is coming. So if I got a big drop in the market, but a little move up in the VIX, tiny move up in the VIX, that's telling me that those big institutional investors aren't too worried about it. That dip will probably get bought right back up again. So if we look at and by the way, it's always extremely important that when you're comparing the VIX, I probably blew it by using Dow examples. That was wrong because you're always comparing the VIX to the S&P 500 because that's what it's measuring. It's measuring the change in those in S&P 500 index options, that implied volatility change. So we always want to compare it to the SPY. So we really haven't moved up strongly these last few days. In fact, we had a real sideways move right here. But the VIX has been moving down. So we're not seeing any concern yet. Now, one thing I did point out that concerned me a little bit, though, is that was the candle for today. We opened lower, but we might end up closing higher than the open right here. And we're getting into a little bit of a support area right here. So is it possible that maybe the VIX is going to move up a little bit, and maybe the market pulls back a little bit? It's possible, but there's nothing today that's screaming anything. And that's where you have to be kind of careful, is because if you're looking for the VIX to tell you something every day, it usually isn't. And sometimes you can look too much into every little movement of the VIX. For example, there was a day when the market sold off. It was a couple months ago where the market sold off, and the VIX barely moved up. So the VIX was down, and it barely moved up. It was early in the trading day, and so my first reaction was, okay, the VIX isn't really worried about that sell-off right there. So I wasn't really worried about that sell-off. It was a pretty decent down day. It was a pretty decent down day. So the market was down a pretty decent amount, but the VIX wasn't moving. But then all of a sudden, towards the end of the day, the VIX started to spike. The market didn't go down much further, but the VIX started to spike. So what did that tell me? Well, it told me that now those professional traders are concerned. So during the day, it changed to where it started to spike. And that told me that, okay, now those professionals are a little concerned about that pullback. And sure enough, we ended up pulling back a little bit further after that. But you got a little bit of a warning sign from the VIX that it didn't happen early in the day, but later in the day, it showed that they were buying those protected puts. It was causing the VIX to spike up a little bit. Now, I mentioned earlier that the VXY is not always moving the exact same as the VIX because this is a trading instrument. You can't trade the VIX. The VIXY is looking at the short-term futures of the VIX. There are people that trade the futures on the VIX movement. Now, that's a real complicated. In fact, that's probably one of the more difficult ways to trade. Futures are already a tough instrument to trade, but then you start trading futures on something like the VIX. That's really kind of complex. So definitely not recommending anyone try to go trade futures on the VIX, but it's going to look a little bit different. Now, like I said, on TradersPro, it only shows instruments that you can trade. That's why we don't have the NASDAQ Composite Index chart on TradersPro, because you can't trade it. So there isn't the chart of the VIX on TradersPro. If you have another charting service, most of the charting services will have, you can type in the ticker symbol VIX and it'll pull it up. If you don't use another charting service, there is a free charting service you can check, just to use to check the VIX. And there's a few free ones out there, but stockcharts.com is one, www.stockcharts.com. And just type in VIX and it'll show the chart of the VIX. And it's free, so it's not costing anything. But you can see here that it's moving, and it's actually moving lower than it's open, so it's not showing any sort of a reversal So this is it's lining up with the move today. Now, hopefully, through this training, you'll understand a little bit better when I bring it up in the updates. It might take you need to go through the training a couple times to kind of get the concepts down. The main concept is that it's measuring the level of freaking out by the big institutional investors. Hopefully that background of how those big institutional investors trade helps you understand a little bit of why it can be helpful to us as traders to kind of see what they're doing. The option part of it, you'll understand a little bit better when I have the option trainings on options, although it might take you a few weeks to learn about options even after the training, just to kind of get them down. They can be kind of complex at first. Really simple once you get it down, but kind of complex when they're brand new to you. But another important thing is never use the VIX alone. It always needs to be combined with other analysis. And if everything else I'm looking at is saying, boy, that the market is looking like it could go down, and the VIX is spiking, I can confirm that. Or, like I said, it maybe a lot of things are looking like the market could drop, but the VIX isn't moving. It's going down. Maybe it could tell you that maybe I shouldn't be too concerned about the sell-off, because the professionals aren't. And a lot of times you're going to be on the right side of the market more often than you'll be on the wrong side. All right, hopefully that was helpful. And that wraps up today's market update. We'll see you on Wednesday again for the stock-specific class. And I haven't decided what I'll do for the trading yet on that one, but I'll announce it in the beginning of class on Wednesday. Thanks, everyone. Bye now.